Welcome to the first LMPG Expert Lock-in of the last 6 months. We've kind of let these fall to the wayside a little bit, but we will be picking these back up once a month, every month, through to the end of the year. I don't know whether are we doing Christmas, Laura? Christmas Day? Is that what you do on your own?
Yeah, sure. Why not?
You and Santa. My name is Anthony Bailey-Grice. I'm the Managing Director of LMPG. I've got Laura Lee with me for her first ever webinar tonight. Do you want to say hello, Laura?
Hi, everyone.
And Laura's going to be monitoring the chat function, which you can see at the bottom of your screen right here. So if you've got any questions throughout the evening, pop it in there and we'll probably break for relevant questions if it's something about a clarification or something like that as Richard's talking. Otherwise, we'll have a Q&A session at the end. Now, there's nothing stopping you, by the way, from simply unmuting yourself and throwing your voice and thoughts into the wide world and putting Richard on his back foot. So that would be quite a fun thing to do. But try not to do it too much because we do want to try and get this done by 8 o'clock. So I'm afraid my long rambling introduction doesn't have a lot to do with actually what we're talking about tonight. Kev Meek, you may recognize from our Facebook group, who is, what is your account manager? What is your title, Kev?
I'm a senior new business account handler. That's my official title. But
he's the insurance man, is what we
I'm the LMPG insurance man. That's how you'll know me. Yeah.
We'll be introducing Richard Graham of Aston Lark in just a second after he attended himself an underinsurance webinar and said, look, it's so good, I want to show all the members. So it's been incredibly popular for us. Just before we get started, I do need to tell you, as you entered this room, you will have heard an American voice saying that it's being recorded. This is indeed being recorded and will be added to our webinar library, online webinar library, and distributed through the email as well. So if you don't want to be recorded, then by all means turn off your camera, anonymize yourself, and you can sit there and listen. You don't necessarily need to jump in and participate and be on the World Wide Web forever and ever and ever. So I think that's my long rambling introduction just about finished. Kev, I'm going to throw over to you and you can tell us all about what on earth are we talking about tonight.
Sure. Thanks, then, Ant. This is a webinar about underinsurance. Okay, but very basically underinsurance. Now, if you don't know what underinsurance is, it's not insuring your property for enough. Now, there's it's a really big issue at the moment. Richard here, I'll introduce you to in a second. Heads up. He's the head of claims and risk management at the company that we're part of. And he came around to our office. He was doing like a roadshow about underinsurance, and it was really, really eye-opening. There's some really scary statistics, which will be kept to a minimum, but you know, the few that he's going to tell you, I think, are really, really important. And it can be catastrophic if you get it wrong. If you get this insurance amount wrong, it's awful. And some, you know, there are stories in here of things that have happened that you will want to avoid yourself. So I think we're just going to cover, you know, what it means to you, what the implications are if you do get it wrong, why underinsurance is such a bad thing at the moment, what's been happening to fuel that, and you know what we're doing to try and help fix that problem. And that's something that you know you can all get involved in, and you will see, you will hear, if you speak to me, you'll hear me talking to you about this, because I'll be doing that from now on. It's such a big issue. So I think I'll hand over to you now, Richard. So this is Richard, head of claims and risk management for Aston Lark, who are, Protect My Let are a trading name of Aston Lark. So we're the landlords and let property specialists in this company, and here's our head of claims and risk management. Richard, over to you.
Wow, what an introduction. Okay, let me share my screen. I know some people are saying that they've got a blank screen, so hopefully if I hit this button, everyone should be seeing a very smiley person on the front with a title slide, property insurance or property underinsurance, and then my titles.
We just have something in the chat, guys, to make sure that at least some of us can see this, because I certainly can.
Brilliant. Okay. So Kev's done a great job of sort of setting it all up, but from my point of view, property under insurance is something that is very close to my heart. So I've got a bit of a strange role at Aston Lark that I'm head of claims and risk management. So claims is all about what happens after the event, and then risk management is all about what we can do before the event to stop a claim from happening. So you've got that sort of duality. But I just see on the claims side so many occasions and issues with underinsurance that I've almost become evangelical about trying to stop this from happening. Now, some of the statistics we will talk about will be quite gloomy, will be quite scary, but absolutely at the end of it, hopefully we'll finish on a positive and we'll tell you that, yes, it is a problem, but it is a problem that's easily fixable, and one absolutely that we can help with. So let me just, good, it's working. So the agenda really will be taking you through just a very, very quick, I don't want to teach everyone to suck eggs, but just property insurance and how fundamentally does it work. The historical problem. So underinsurance hasn't just been here for the last 3 years, it's been here for as long as I've been in insurance. I started insurance back in 2000, and we've been talking about this within the industry for as long as that, which is just terrible that it's still happening as prevalent as what it is. We'll talk about what we call the 2021-2022 problem. Couldn't think of a snappier title, but Ronseal, it does what it says on the tin. The current problem, and then we'll sort of go into the actual consequences and the solutions. The consequences are, okay, underinsurance, we understand that it's a problem, but what does happen on an insurance policy as and when the insurance or the insurers do say, I think you've got a problem, you haven't got enough sum insured. Just very briefly about me, as Kev said, head of claims and risk management. I've been within the business since 2001, and I've covered a number of roles within that time. So I started off as a trainee account executive, actually, funny enough, worked my way through the business to a point where I looked after one of our large commercial offices in the southeast in Kent, and that entailed being an account director or an account broker, depending upon who you speak to, for a large, or I tended to focus on large real estate, large property owner clients, manufacturing and retail clients, and then finally moved into claims and risk management in 2016. But what that's given me is this sort of privileged view that not many have, actually, where I'm seeing things through the eyes of a broker. So that is like Kev, who places the insurance in the first place, and then seeing it from a claims point of view as well. So how the policy responds when a claim happens. And that has just caused me to, as I say, look at this in a whole different way and really try and get out to all of our clients, Aston Lark as a group, and try and make sure that not on our watch will this impact or affect our clients. So as I say, almost evangelical, really. So we need to go back really without complicating, without being too boring, talking about insurance. There's probably a couple of technical slides, semi-technical slides, but fundamentally, we need to remember that property insurance is all about protecting an asset, and usually an expensive one at that. And the asset is that expensive, in fact, that most people need to transfer the risk of loss to an insurance company. It's not something that they can bear themselves. So, depending upon what the minimum is, what we count the minimum, but £350,000 is usually the minimum insurable value of an asset. So you transfer the risk to insurers because you can't afford to bear that yourself, and that's all underpinned by an insurance policy. And it's making the point here that insurance policy is a contract and it is an agreement, and the reason why that's so important is that with something so expensive and so important, you want there to be certainty of outcome. So you find with an insurance policy, yes, it's a legally binding contract. Yes, it should deliver certainty of outcome for the policyholder and also the insurer. But typically speaking, and I know policy wordings can be quite complicated and long and a bit boring, but you have this situation where fundamentally an insurance policy does this. It says that if A happens, then the policy will do B. So it's an agreement between two parties. But it also says, because we have these terms and conditions, that if the policyholder doesn't do C, then the policy won't respond at all to the loss, or as we'll talk about later on in the presentation, it won't respond to that loss, or it won't respond at all. And there are scary things with underinsurance that we'll talk about, where it's not just a matter of the policy not responding to that particular loss, to that particular claim. It's that insurers dive out of the policy altogether. And we'll talk about the potential implications of that. So this is probably the last technical slide. You may have heard Kev talk about, hopefully you've heard Kev talk about the duty of fair presentation, which came into force via the Insurance Act 2015. And what that basically says is, because insurance is all about, insurers will not come out and physically see your property. So they have to trust what's been told to them about your particular property for them to consider cover, consider the right premiums, consider the right terms, consider the right coverage. So it's important that we have this duty of fair presentation, and we'll go through this in order and as snappy as we possibly can do. But before a contract of insurance is entered into, the policyholder must make to the insurer a fair presentation of risk. So then that naturally goes to say, well, what do you mean by fair? Fair, according to the courts, is disclosure of any material circumstance which the policyholder knows, or importantly, ought to know. And you find these things in contracts, and certainly within insurance law, it's all about what reasonably you should know as a policyholder about what it is that you are wanting insurers to insure. So we then go to, well, what is material? And again, the courts define that anything that would influence a prudent, sensible insurer in fixing, calculating the premium and or terms of insurance, and whether they want to write and accept the risk. So that's all plain sailing, really. You can all sort of understand that, and that makes sense. So insurers are not coming out to see the property, and therefore we need to tell them all of those sorts of things so that they can adequately provide me with the right cover and with the right premium. And what this means for property insurance, summarized really, is you need to tell the insurers what the property is made of, what they're used for, and importantly, the adequate cost to rebuild. Because when Kev calculates a premium for you, the premium is very much a rate per 100 or per 1,000 of sum insured. So how much you contribute to the big insurance pot that there is based very much upon what you say is the cost to rebuild your property. So it's important that you fix that and you get that right. So the historical problem, like I said, so, and as Kev sort of discussed at the start, this hasn't been around just over the last few years. So loss adjusters and insurers and surveyors have always talked about the problem of buildings being underinsured. And the traditional or historical view is that this is caused by those things. It's caused by confusion by policyholders on what is supposed to be included in the buildings rebuild sum insured. So things like debris removal, professional fees, hard standings, fences, outbuildings. Some clients aren't aware that they are to be included within the building sum insured. Lack of time. You know, the fact is that we are all exceptionally busy. And it does take time sometimes to sit down and properly consider the adequacy of your sum insured. For some policyholders, especially at the moment where a client is aware, or a policyholder is aware that if they increase their sum insured, the premium will increase. that sometimes causes them to not want to increase sum insured, even though they probably know that it isn't sufficient. And there will always be a difference between sale and rebuild, but that is a historical issue that we find, is that policyholders are still rating some of their sums insured on the retail value. And those two are entirely different things, operate in different market cycles. So where you've got a peak in retail, you tend to find that it's the opposite on the other. Rebuild values tend to be fairly constant because it's fundamentally based upon labor and material costs, whereas retail follows the worldly sort of market cycle. And then another reason for the problem of underinsurance has just been that people tend to rely on old valuations. An old valuation, according to insurers or loss adjusters or surveyors, is anything really over 3 years. And sometimes buildings change. So you've got a valuation that you had carried out 5 years ago, but the property bears little resemblance to what was included within that report. So that's the historical problem before 2001. And ultimately, it does come down to just a lack of understanding the consequences. And this is where I think as insurance brokers, and I'm not talking about Kev, because I know Kev does talk to you about this, but we have to absolutely be clear with you the consequences of getting it wrong, because I'm sure that if you're aware, so if you have an asset that you're insuring for $500,000 or $1 million or whatever it is, that the last thing that you want to do is underinsure it if you are aware of the implications and the consequences. There wouldn't be a confusion on the rebuild sum insured. You would take the time to properly consider the adequacy of the sum insured and what you'd need to do to get to an accurate figure. You wouldn't care so much about the premium increasing because you know that you're adequately covering what is a very expensive asset. So it's a part to play for us as well to make sure that you're aware of the consequences. And that's really what I've been doing as head of claims and risk management at Aston Martin really for the past 2 years. Lots of webinars, lots of talks within the business, outside of the business, talking to all of our clients, contacting all of our clients through different methods, just really to say, look, we don't want this to happen to you. But here's...
Sorry, can you go back? I'm just going to put that to the test then, because we've got Kev with us. A lack of understanding of the consequences. So, Kev, I know that one of the questions that you ask, can you speak to pretty much every LMPG member over the course of a year? And one of the questions you'll ask is, what is your rebuild value? And every now and then I'll get a call from you, or we'll sit on a meeting and you'll say, I'm asking this question about the rebuild value, and I'm just getting people getting really angry at me, and they don't want to tell me it, and they don't want to go and find it out. So what's the response that you get then?
Right. So half the people I speak to are interested. They want me to tell them how can I find my rebuild value out? Is this right? Is it not? And they'll accept the advice. Some of the other challenges I get are, like we say here, lack of time. No, I want it done quickly. I don't want to have to research this. I want my insurance done.
Sure.
With that, the problem you've got with that is you may as well not do it. If you're not going to do it properly, you just want to get your insurance done. So you
do what? May as well not get an insurance policy.
You may as well not insure it, or you may as you're not worried about insuring it properly. It's if you're going to do that, if it's worth doing, you need to do it properly. And it doesn't actually take that much of your time, and it's really if you want to get a proper valuation, it's inexpensive in comparison to what you'll lose out on if something happens, or what you potentially lose out on. But that's the main challenge. The main challenge is lack of understanding and lack of time, and I think that's or thinking you've got lack of time. I think that's where this underinsurance thing it needs to be more of something that people are talking about. And it's unfortunate that not some people will only start worrying about underinsurance when they fall foul of it. and they see what the damage
And that's
does.
the case with pretty much everything with insurance, right?
Yeah, exactly. You don't see the benefit or the value of it until something happens. Exactly.
People that fall foul of underinsurance never fall foul of underinsurance again.
That's right. Yeah, exactly. Yeah.
It's
Correct.
a one-time thing, but it is a one-time thing that can. But I also think we don't help ourselves in the insurance industry because we call it underinsurance, and underinsurance just appears quite soft and cuddly. It doesn't appear catastrophic. It doesn't come across as all that awful. We're just slightly underinsured.
What we did, because originally this webinar was titled Underinsurance. I didn't like it because it sounds a bit boring, to be perfectly honest. So what I asked Laura to change it to was "Sorry, you're not covered," because straight away there is an emotional attachment to that phrase of "Sorry, you're not covered." Wait, hold on. That sentence has just cost me £700,000, whatever it might be. I think underinsurance as a concept, it very much sounds like a concept rather than something that realistically should have some level of emotional attachment to. So Caroline has asked in the chat here, and I'm hoping that we're going to get to this in a second if I hadn't interrupted. How do we get our rebuild value properly, like you say? And do we need a new value for every insurance cycle?
Perfect. Well, I think I'll talk to you about the solution at the end if you don't mind, because I think what we're trying to do is go through this in an orderly fashion to tell you that bottom line is we have a solution that is cost effective. So the typical problem of people not wanting to carry out or have a professional evaluation is cost, because a professional boots on the ground surveyor coming out and giving you a professional valuation can cost 500, 600, 700. And that scared most people away from having that done on a regular basis. It was too much of a cost. Whereas we've come up with something with a RICS approved firm that for most people is sufficient, and it's £99 plus VAT. It's a desktop valuation by a RICS approved firm. So
is there a time saving to that as well?
Is there a
time saving?
Absolutely. So desktop valuations can typically be carried out within 72 hours.
Okay.
And it's the same methodology. So whether you have a boots on the ground, RICS approved rebuild cost assessment, an RCA is the sort of technical term, or whether you have a desktop, the methodology and the rationale and the time spent on the actual valuation is the same. It's just that the point of reference with a desktop is clearly using open source Google Maps, any other open access that they have. And a boots on the ground is physically measuring the sites and looking at, the insides and outs and lifting things up and things like that. But insurers, from our point of view, will accept our desktop valuations, which is the key thing, because what we're trying to do is stop underinsurance and stop wrong insurance. So it's £99 plus VAT is effectively the answer to everything that we're saying here, which is, I've got 23 slides. I don't even need to do the rest now. That's it.
Let's get back to it then.
That's fine. No, that's done. So historical problem. Historically, like we said, loss adjusters said that 70% of properties were underinsured, needed an average uplift of 30%. That was the accepted view from loss adjusters, insurers, and surveyors. And all I've done is brought that into an infographic here that says there 70% underinsured pre-2021, 2021, an average uplift needed of 30%. So from information that I found, and I've probably got this utterly wrong, if there is 2.5 million landlord properties, then 70% means that 1 3/4 would be underinsured. And if we use an average property sum insured of 350, then according to those statistics, the historical problem creates a shortfall of 184 billion, which is absolutely scary. And it's until you sum it up, and that's the historical view. So we're about to go on to the really scary stuff in a second, but that's the view before 2021. 7 out of 10.
That's just the shortfall. That's the difference between what it's valued at and what it should be valued at.
That's the uplift needed to make sure that people's buildings, property, asset policies were adequately insured. So that is horrific. But that is, like we said, that's horrible enough by itself, but that's statistics that really go back. So historical problem, we then talk about the snappy title of the 2021-2022 problem. And this is fundamentally what's happened in terms of the world. So, you know, Brexit gives you labour and material concerns, and we've heard of all of those excuses. You know, all of these are not new to us because they're used in different situations. COVID-19, obviously factories closed, transport was restricted. There was this global increase in construction demand, shortage of HGV drivers, mainly due to Brexit. And then we had the Ukraine war, and all of that did is compound certain issues that were already there. And hopefully, if I go into this to a certain degree, sorry, there we go. So we've got a few lines there, and hopefully it's large enough for you to see, but pretty much we've got labour rates at the bottom. That's what they did during 2021, 2022. Pretty, you know, the hit to the labour rates was already felt because of Brexit, to be honest. So we were already sort of running at those being sort of 5% by the time it got to August 22. And then we've got the sort of general building cost index, which is the light blue line. Probably could have differentiated those slightly better. And the key thing there really to show is this, is if you've got an historical problem of underinsurance due to all those issues that we said before, lack of time, lack of understanding, you've still got those things happening during the 2021-2022 problem, but you've then got material costs increasing at a peak in June, July 22 at 25%. And we all know that's true because we all know that we've had building works done. Amazingly and ironic, as Heather claims, is back in January 21, my house was destroyed by a fire, believe it or not. Yeah. So I've sort of experienced this real time. Obviously, I had the support with the insurers. I did have the correct sum insured. Thank you, because that would have been highly embarrassing if I didn't. But I've experienced this firsthand in terms of the time delays. You know, so when did it happen? January 21. I didn't get back into my house until August 22.
Wow.
It took that long for me to get back into my, and when I say my house was destroyed, the roof was destroyed, the loft was destroyed, the first floor was destroyed, the ground floor was by the water, the extinguishing water, but I had the bricks. It was just literally everything inside the house was taken out, the wiring, plaster, you know, pipe work, everything else. But I still had the outside of the building. And even then it took that long. And I know from the cost to insurers that the cost of timber, the cost of steel, and we all know that because we've all had certain works done, that isn't a surprise to us. You know, the cost of, you know, the construction cost inflation. And there's certain, you know, we're saying that's the 2021-2022 problem. We've seen certain rating cards from people like Jewson that are still put some price increases through at the moment. There is talk, hopefully, that the construction cost inflation towards the end of this year might go down to 5%. But who knows what the next world crisis is that is just going to keep them, unfortunately, jacked up. So you do have this sort of issue that if you look at the historical issue, lack of time, confusion, you've got the 21 to 22 or 23 issue, that just gives us this position now that is utterly scary. So the historical problem was, we said 70% underinsured with an average increase required of 30%. Well, we said to you that we had found a solution because we thought the major hurdle to people wanting to adequately insure their buildings or understand what the correct sum insured was the survey costs, these rebuild cost assessment costs. So we launched our desktop service last year, actually this year in January, and to date we have carried out 3,000 valuations, and we found the problem is that much worse. As a group, so this is just Aston Lark, but Kev will say that we're actually part of the Howden Group, which is a lot bigger broker, global broker. But in terms of UK in particular, we have actually carried out 4,000 valuations over that time. And it's still roughly, it was as high as 80% for a lot of that time we're underinsured, but that's come down to 73. But the big thing is that the average increase required that we found from those 3,000, now 4,000 valuations carried out was 61%, not 30%, what we first thought. But that sort of makes sense, because if you go back to the previous slide, and we haven't corrected this underinsurance over that period of time, and you had the historical problem, you've got the current problem, that is effectively the difference in material costs. So I don't know why, you know, when I've given this presentation elsewhere, people have sort of quite gasped in horror, but when you see it on the page, it does shout out. And for our clients, that's 3,000 valuations, and that's 61%. The shortfall was £1 billion. So our clients automatically uplifted their sums insured. This all happened before a claim happened, thank God. So that's really what we've done to protect. And if you sort of overlay those new statistics as we see them, which we trust more those because they're our clients and they're the valuations that we've actually had carried out, then you're looking at nearly 2 million of those 2.5 million are underinsured. Using the same average property sum insured of 350, that's 390 billion. And when you're looking at those numbers, 189 billion, you know, 390 billion, 14 squillion, it sort of, you get to sort of numbers that you just can't relate to, because it is so huge. So we've talked about what an insurance policy is, how it operates. We've talked about the historical problem of underinsurance as we see it, the current problem due to the increase of construction costs. We then talk about the even more gloomy subjects of, well, what happens to your insurance policy if underinsurance is discovered? And underinsurance is always discovered at the point of claim. So what tends to happen when you have any degree of loss, whether it's partial or total, is an insurer will appoint or instruct a loss adjuster. And they are tasked, loss adjusters, to consider coverage, so to make sure that you've adhered to the terms of your policy. But also, first thing they do is check adequacy of sum insured. That's what they're tasked to do by insurers. And there are two remedies available to an insurer if they discover underinsurance. The first is proportionate remedy. It's a concept called, or principle called, average, which we'll sort of go into a second, and that is effectively where they pro rata adjust your claim in line with what your underinsurance is. So effectively, it's something like this. So if you have a sum insured under your policy of £1 million, but insurers have discovered at the point of loss that it should have been 2 million, then the adequacy of sum insured is 50%, it's half. If your actual loss was £1 million, then they will adjust. You don't get £1 million under average, you will get 50% of that, which is £500,000. So that's the basic principle, and that is fair. It might not sound it, but if you've got this situation where you've got two buildings, for example, they're identical. So you've got one policy holder A, you've got one policy holder B, back in October 21, destroyed half of the building. Policy holder A has a sum insured of £2 million, which meant that they paid premium for £2 million. The rebuild value is £2 million, so they've insured their property correctly. Policyholder B, unfortunately, has a sum insured of £1 million. They're half the correct sum insured, and the damage is £1 million. Now, under both of those policies, it wouldn't be fair or reasonable that both receive the same claim payment. Utterly not, because one has contributed their fair share to the insurance pot, and therefore policyholder B shouldn't really expect to receive the same outcome, financial outcome, as policyholder A. And average stops that from happening. Average makes sure that policyholder B receives half of what they should do because they're half insured correctly.
That's ludicrous. You can be insured for £1 million of £1 million worth of damage, and they give you 500,000.
Because you're not insured, because you've got to look at it from the point of view that you have only contributed. So you have effectively paid half the premium that you should have done. So because you've only, and the way insurance works is that it's the losses of the few pay, or the contributions of the many pay for the losses of the few. So it's really, really important that the contributions of the many accurately reflect the risk that they bring to the pot. Because if you had all these situations where everyone received £1 million, no matter what the sum insured was, then the cost of insurance would become far too expensive for us all to pay. Insurance is a mechanism for us to, as we said, we need to transfer the risk to an insurer, because we can't bear the loss of £350,000 if we use that as the illustration. So it is a fair and reasonable concept that has been used in insurance since time began, since this was all fields.
I'm sure that whoever is receiving £500,000 and is now £500,000 in the hole would be very comforted by that, Richard.
Which is why we're talking about the subject of making sure that we get this right from the outset, because that's what we're trying to do, is to avoid this ever happening at the point of claim. That's not the time where we want to be having those conversations. We want to make sure right at the outset that we are setting the right limits, so you're getting that certainty of outcome from the policy. So that's the rationale. But we did say that that's the best outcome under insurance policy. If we found out
it gets worse.
Yeah, it gets worse. It gets worse. Yeah, it does end on a positive, I promise. We're going downhill at the moment. We will go uphill slightly. So if any of the information, like we say there, provided by the policyholder is found to be incorrect, so like we say, it's a whole trust thing where insurers are not going to go out and see your property. They're going to take your word on what it's made of, who's using it, and what the sum insured should be. That they can, there is a remedy open to them where they can cancel the policy and treat it as if it never existed. Now, that's reserved for the very severe cases, but under insurance law, this is sort of mainly reserved for where it is found that the policyholder grossly or recklessly or deliberately misrepresented the facts. And if that's the case, and if it is gross, reckless, or deliberate, then insurers, regardless of anything else, have the ability to just cancel the policy. And in fact, and this is the horrendous thing about this as well, that if they do that and it is gross or reckless or deliberate, they're also able to keep the insurance premiums, just to add salt to the wound. So when Kev says, if we are not going to insure our buildings absolutely properly, and this is a potential remedy for insurers, then that's what he's meaning, that it's just not worth insuring the property in the first place, because this situation can happen. It doesn't happen that often, and I will say that. I think insurers do get a bad rap a lot of the times, but insurers do always try and lean on the right side of this. But it is just something that we have to share, because potentially it is a remedy open to them. Because if we are to say, what is gross, then the courts tend to sort of rely on these two definitions. If something's deliberately misstated, i.e. to keep a premium low, then that is something that would fall into the gross category. And recklessly is more of the issue to us. So this is where you find that someone has just not taken what insurers would say is reasonable care or reasonable time to make inquiries about something that they ought to know. So if, for example, and we have had situations in the past, and we've managed to navigate around them, but where we had a building that was insured for £1 million, yet at the point of claim, it was deemed to be 5 million. Now, that insurers would say, look, surely you knew that in £1 million, we haven't seen your property, so we're trusting on what you're saying. It should have been insured for 5 million. That is recklessly misstated. And potentially they didn't, but potentially they could have avoided the policy altogether and kept the insurance premiums. So that all said, and I sound like I've made insurance horrific. It's not. Hopefully I've tried to explain the rationale behind why an insurer, or why we need to make sure we've got property sums insured correct. But it is as simple as having a professional rebuild valuation carried out once every 3 years, ideally. Because if you do that, then us as your insurance brokers can include clauses and conditions that will stop an insurer from applying average to your policy. So if you commit to having a professional valuation once every 3 years, you're protecting your asset and you're making sure that we're getting that certainty of outcome from your insurance policy. But like we said, in the past, to have a boots on the ground, fully RICS, so Royal Institute of Chartered Surveyors compliant rebuild cost assessment and RCA, can be quite expensive. They can start from £500 based upon the complexity of the building and the sum insured. They can go up to well over £2,000. So whilst that is a solution, in some cases it's not viable, because as we found in the past, that solution has always been there from since we've had the issue with underinsurance. We have this desktop solution. So we've talked about this a couple of slides back. So we've called it Benchmark. We've partnered with Barrett Corp and Harrington for our clients. And effectively, if your property declared value, DV, is less than £5 million, or in terms of private dwelling houses, PDH is less than £2 million, then we can carry out a desktop valuation for £99 plus VAT. And that is something, again, if you have that done once every 3 years, and we get Kev and his team to make sure that we use the right markets that will include a clause that means that if you have that desktop valuation carried out every 3 years, they cannot apply average. And that's, hugely important. We've taken away all of that issue that we've just talked about on what is such an expensive asset. The valuation service, so we can do commercial, we can do residential, we can do flats, RCAs, major reviews. We'll talk about those in a second, because we've got this, sort of chain to make sure that there's constant protection for your property, to make sure that we don't fall foul of these insurance things. And it's this. So a perfect situation, this is a perfect situation, is you have a site-based rebuild cost assessment. So that's boots on the ground, measure your property, have a full valuation carried out, and then that lasts for 3 years. But in 3 years' time, if there's no changes to your property, what we would do is carry out a major review, which is effectively a remote desktop valuation that enhances and will renew that site-based rebuild cost assessment for a further 3 years. So you're talking about only at the 6-year point will you then need to have another revisit, another boots on the ground, and then that will last for another 3 years, and then you go constantly in that cycle. Now, obviously, a site-based RCA, like we said at the start, can cost £500. The major review only costs £99 plus VAT. So again, it's something that's cost-effective, and for properties that fall outside of that criteria of a desktop, which is £5 million declared value, that is something that will just constantly keep you in that situation of not having to fear that your insurance policy won't pay out absolutely what it should do. So I've just put some things up there really sort of for you to have access to. So whether you're a client of Aston Lark or Protect My Let or not, this is available to you here and now. Get in touch with me or my team at riskmanagement@astonlark.com. Alternatively, go onto our website where you can directly order a desktop valuation for £99 plus VAT, depending upon, like we said, declared value being less than £5 million. And we can do up to grade 2 listed, which is effectively 97% of the landlord properties in the UK. And that's that. Hopefully I've finished on the up.
Well, you've finished on an up, but I've got quite a few questions for you. I'm sorry, I'm just in the middle of writing down that website link and my pen ran out of ink. So perhaps we'll put that in the description for the webinar afterwards as well.
Of course.
Thank you very much for that, Richard. I experienced a lot of emotions during that presentation. I must admit, a lot of them were anger, was sadness, was grief. I was expecting underinsurance with my limited knowledge to be, I've insured my property for £2 million. The whole thing's burnt down and the rebuild value is £3 million. So I'm only going to get £2 million. But actually, what you've demonstrated is I'm actually not even probably going to get that. I'm going to get maybe 1 million or
Well, no, well, that's an important thing to note, and that's a good question. So when we talk about average, so 99% of the losses that happen are partial loss, not total loss. So the number of total losses where your building burns to the ground are few and far between. But if you think that penalty that insurers are trying to have you have in terms of not insuring your property on a total loss is exactly that situation that you said. If you have insured for 2 million, yet your rebuild is 4, they will pay £2 million. They won't apply average in terms of a total loss. So you have experienced that penalty. Average is applied on partial losses, which most of the losses are. Okay. I'm sure you're still angry, so I understand your anger.
Yeah, I'm slowly getting over it. I've got quite a lot of questions here,
Sure.
and I think I'm gonna start midway down, and then I will work my way up. So don't think, members, that I'm just ignoring you. But this is one that I had myself, and I think this is potential to a lot of LMPG members here. Landlords will join LMPG because typically they'll have a project. They'll get a property, they'll refurb it, add value to the property, maybe put an extension in, whatever it is, and then let it out. But the insurance and the rebuild value will be typically calculated before they've added all that value to it. So if there's a refurb that's been done and value's been added, let's say an extension's been added to the back of the property, presumably it's not just that 3 years that member would have to wait. They would actually need to get the rebuild value checked almost immediately after they've finished the refurb.
Kev, do you want to build that, or?
Well, yeah, I mean, this is the thing, it's your duty as a property owner or a policy holder to keep an eye on your rebuild value. So if it changes and you do work to it, you build an extension, you fit it out with some high-end kitchen, bathrooms inside, it is up to you to keep your insurance policy up to date. And it will say that in every insurance policy somewhere or another. This is the duty we were talking about earlier. But yeah, it's up to you to make sure that is still in place. If it means getting another valuation, if you really don't know, then it is something you should do.
I think there's something that we can do with that as well in terms of our value. So it depends on how big the refurb is, but at least if you have the starting baseline of what your property is before the refurb, you should know the refurb costs yourself because they're live, they're current. And that's something that you can obviously add on to the calculation. But BCH in particular will do a before and after. And again, they will try and wrap that up in their desktop valuation. They will come to you and ask for sort of a bit of assistance in terms of the refurb cost, because you know those far better than what BCH will do. But it's a good point, and absolutely something that you need to consider the before and after, but something that's not sort of insurpassable in terms of the valuation services that we have.
Nick has asked, one thing I'm often told and have experienced is that there's a magic 3-week period when it's best to get a new quote if we're searching for alternative prices. This is less underinsurance and more insurance generally. Is that a rule that you follow, Kev, or when do you think is best for members to kind of get in touch with you and say, my insurance is coming up?
No, there's no the prices and premiums that we offer aren't based on a 3-week magic sweet spot where the premiums come through and they're best. There's a new directive that's coming in that's everyone will be informed about, that everybody has to be treated the same, no matter what point of their life cycle, their policy it comes to. So you've got, if you get a new quote at this point, it will be the same as what your renewal would be if nothing has changed. So no, the insurers we use, that isn't isn't something that will happen. It's certainly not something that should be happening going forward. I mean, I've heard similar rumours. I've never had any hard and fast facts, but I've heard similar rumours when you're looking for your motor insurance on a, a compare site or whatever. It's
Absolutely.
there's a few days, if the longer you leave it till your actual renewal date, the higher it is. I've heard that as well. Never seen any hard facts, but I've heard that as well. But not with us.
When's this directive coming in then?
It's now. It's around now.
Okay.
We'll get back to you on the date, but it's around now.
So can I interrupt on that one? It was me who raised that question, and it certainly does apply to car insurance, because I bought a new car trying to get it insured within 4 days, and the price was astronomical.
It went up.
And every time I went back to have a look at it, it added another 50, 60 quid. I was going, this is not fair. But that's why I was asking the question, is it applicable to buildings and contents insurance as well? Because it certainly does happen in car.
It's on the aggregator sites, Nikki. You'll find that where there, you go to the, you punch in your details, you can get a load of quotations without naming any individuals. It's how their rated engines work. And I can imagine that there is a point in time just before they push new rates through. But there used to be a time in motor insurance where they used to put the rates up monthly. I think that changes. It seems to be changes are far more frequently now. So I can understand the question, but that doesn't happen to commercial insurance, buildings insurance, like Kev will offer.
Well, that's a relief.
Yeah, that's good.
Jonathan said, do you have any stats on market value versus rebuild value, and how many properties are overinsured?
We do. So we do, with our valuations, track overinsured, and I think the overinsured, I'd need to go onto sort of our dashboard that we have, but overinsurance, well, effectively, so if it is 70, what was the stat, 73%, there is no, there are no properties that are dead on insured. So the balance is 73, 23% have been found to be overinsured, but the overinsured are not overinsured by that much, which is why on those 3,000 valuations that we've had, the 73 deemed to be underinsured, we've got this £1 billion cumulative sort of uplift needed to these sums insured. So yeah, there is overinsurance, but obviously it's a lot rarer than underinsurance.
With that in mind, that no property is ever, the rebuild value is exact, at what point does underinsurance really become a problem? Because presumably you can be 5 or 10% off and effectively be as close as you're going to get.
Great question. And you can, and even with Royal Institute Chartered Surveyors, you could have one firm insure it on the value it on the Wednesday, another on the Thursday, and you find that there might be 10%, 15% variance between those, even though they're applying the same sort of or they're using the same indexes. It's 15% basically. So insurers will tend to waive average if the adequacy of sum insured is around the 85% mark, but that don't sort of reference me on that exact figure. Certainly from our point of view, my point of view as head of claims, if I've got an insurer trying to apply average at 85%, we wouldn't take that kindly at all for our clients.
If the property is overvalued, how does that affect the potential claim?
It doesn't affect the claim. So what we always say to our clients, that if they've had a valuation carried out and it shows underinsurance, then by all means you'll pay an excess premium, because like we said, your premium is based on a rate per 100 or per 1,000 of sum insured. So it doesn't affect the claim, that doesn't come into it. But we always recommend that clients reduce. If it's always nice to have a bit of a healthy buffer, but if it's too much, so if you've got something that's 500,000 overinsured, which never happens, or 30,000, we'd always recommend that they reduce it accordingly.
You're not getting those premiums back, I assume, when you do come to claim.
You're not, unless you change the sum insured at the point that you discover that the valuation. And I think there was a question on, I can't remember who it was from, so apologies, but just looking at the chat about, if I have a valuation and I find that I'm underinsured, what do I do? You contact your insurer immediately. Because it's a material fact at the point that you discover. So that's the other thing, is that as soon as you've had a valuation, you need to jump on that information as soon as you get that. Talk to your insurer, or talk to your insurance broker. Make sure that they increase the sum insured or the declared value in line with what your valuation says.
Okay, and you said to speak to your insurer, so that's directly with the insurer. Is that with Kev in our case?
Yeah,
Insurance, yeah, some people may have some direct to insurer, which obviously we would never recommend. Always use an insurance broker for the advice part of it. But yeah, talk to Kev or talk to your insurance broker.
Lovely. Does my insurance work for my neighbouring property, as in semi and terrace?
I'm not sure what quite the question is. So effectively, it depends what you have insured under your schedule, because some people within this group might have multiple properties insured under one policy.
So let's say that I've got a semi-detached house and it catches fire, and the neighbour's house catches fire as well. Now, in that case, I'm 50% underinsured because I've burnt their bloody house down as well.
No, so this exactly that. So okay, let's go back to my personal circumstances, and if I start crying, then it's everyone's fault for bringing it up. But we have this situation where the cause of the fire was actually my damn neighbour, who is 6 foot away. Their garage, literally 6 foot from where I am, their garage went up in flames, and it caught my house alight. So that the fire didn't start in my property at all. It hardly damaged their house, which really annoyed me, but that's that. And totally took my house down. Now I had to claim under my own insurance policy, and then what would happen is, if there was negligence, then I would claim against my insurers would recover their losses from their insurance policy. There wasn't negligence because we couldn't find that they did anything wrong that they shouldn't have done. It was just one of those things. So in that situation, you are only called to insure your own property. If you damage the other person's property, they will claim under their own insurance. And if there is negligence, they will come into and claim against your property owner's liability policy.
If they're underinsured, well, it's just hard luck, right?
It's their issue, because they should, regardless of whether fire starts, their fire has been damaged or their house has been damaged by fire, their own policy needs to be suitable.
You'd probably want to move even if you do get the house rebuilt in that case, though.
Well, yeah. Well, I've got cameras everywhere now. Literally, it's ridiculous.
So Will Riley from Protect My Let is in the chat here. He said that the consumer duty is 31st of July. Is that what you were talking about, the directive, Kev?
Absolutely, yeah.
There you go.
31st of July. Thanks, Will.
Yes, Caroline's already been answered. You've already done that one for me. General insurance question. I've heard in the grapevine there are changes coming in regarding to what counts as a flood risk area. Can you touch on these changes? Do you know about these at all?
Well, this is Richard. This is something that changes all the time. If you're talking about where flood risk areas are,
yeah, it does, because the main issue with flood isn't actually tidal. So it isn't if the rivers break their banks. It's more standing water, surface water flooding is what we have now, these flash floods, and that's all to do with insufficient drains, built up, development areas, not enough green and too much concrete. And these flood maps change all the time. You have the environmental agency that have their idea of what flood is in particular areas. And then insurers, one of their main investments over the past 5 years have been in their own individual flood maps. And they can now drill down to individual houses within a street. And you might have one house is different to another house depending upon where it's situated. But that is, again, very different from one insurer to another, but they're constantly changing. Because that is a real horror situation for insurers, is the increasing threat of flood. It worries and scares them.
It came down quite heavily about a month ago where I am, and a couple of streets away, all the basements flooded and all I think the living rooms as well in some cases. But in claiming for their insurance, the response that someone got was that it hadn't rained long enough. That there's a certain amount of rain that needs to come down during a certain period for that to constitute a flood risk. the reality is that their basement was flooded.
Yeah, it's water. It's you know, and I'd love to get hold of that claim if anyone knows that, because and this is the reason for using an insurance broker from my point of view, is that you need someone to represent you as a policyholder. You need someone to fight your corner, because insurers, to be honest with you, insurers, and we see it more often than not, are very fair and reasonable. They're always looking at reasons on how to pay a claim rather than not pay a claim. But there are certain situations where they get it wrong, where they decline a claim or repudiate a claim, and it's simply, no, we don't agree with that, and we're going to fight you on that. And we obviously have the back-end, the legal knowledge, the insurance knowledge to be able to do those sorts of things. Because if you go direct to insurer and they decline a claim, then where do you go? You know, it's difficult.
Absolutely. So I think I've got a final question here. Laura, are you still there?
I am.
Good. Well, Laura was very worried tonight that she was going to make a tit out of herself because it's her first ever webinar. So I'm going to leave this final question to you, and we'll see how you get on.
I don't know.
See this one from Robert Simpson.
No.
No. Okay, I'll read it out. But you know, at least we got you on the webinar. Rob said, in the past, I've used the RICS website to get rebuild values.
Right. So that the RICS website, the thing about that, so it'll ask you about 9 or 10 questions about your property. Right. Now, the difference we've got with the RICS valuation website and actually getting a proper valuation is that website relies on you to put your information in. Okay. Now, there are certain things on, like, provided that you've got everything absolutely spot on and right, you've got a pretty good guess at your valuation, but it might not be a recognised thing if you have a claim. Is that right, Richard?
Absolutely. So
you've done something yourself.
Yeah, it gives you a basic starting point. It's more like a very rough indication, because and we can share this with anybody that's interested. We can sort of take you through the rationale, the methodology of what BCH do to carry out a desktop valuation. It's an elemental where they will go to numerous sources. They'll go to a building materials source called SPONS. They will use RICS. They will use BCIS, Building Costs Index. And they bring that all into, and they talk about locality as well, because that can have a huge impact on the difference in rate per square foot. They'll look at the individual property to understand whether they should use sort of, you know, middle quartile, they should use upper quartile on a particular rate or lower. And then they're building relevant professional fees and an adjustment for professional fees and for debris removal. And then what they do is they then will sense check what they've come up with a physical valuation that they've had carried out in that area with that particular type of building. So there's all these different sense checks that they go through to try and get that desktop as accurate as they possibly can do at the end. And as per Kev said, insurers will not take a self-RICS valuation. It's meant to be a bit of a fag packet type, very rough indication, rather than anything that insurers would go on in the event of a claim.
I was hoping someone would come on and say this. So just a final point before we go, and Will, who is, of course, from Protect My Let, so take this information as you will, but I don't believe that he's lying here. He's saying that they did a RICS valuation on his mum's house 5 years ago, thinking it was okay. Turns out he's 30% underinsured. So kind of just echoes what you're saying here. Now, Andre has said, sorry, I beg to differ. From my personal experience of loss adjusters, they do their utmost best to reduce the payout. And having been involved in general insurance since the 80s, I've had plenty of experiences to base my opinion on. Simple solution, bite the bullet and make sure you pay for the correct level of insurance.
Okay, I will say to Andre, absolutely. In the end, that's the right thing to do. Get the right insurance in the first place. I can only talk on my experience.
We've managed to come to the same conclusion, but your opinion on insurers may vary. And I'm sure for those that have been on the end of the phone when their claim has not gone through as they would like it to go through, absolutely, it's a horrific experience. But that's enough with the doom and gloom. We've finished with the webinar tonight. We do have a solution. But I've really enjoyed the talk, Richard. So thank you so much for coming on, and thank you, Kev, for recommending that we do this. I know that you mentioned this in passing at the summit last month, but certainly not in the detail that Richard's gone on to tonight. So thank you so much for joining us tonight. So that is. Going to stop your sharing there. That is the end of tonight's session. Thank you so much for joining us, everyone. We are doing, as I mentioned, we've got a webinar a month until the end of the year, this year, and next month we'll be talking about something much more fluffy, should we say, in home decor, home staging, and that will be with Fabian Miller, of course, the home staging award-winning phenomenon. She put something on her Facebook group just last week, which I really enjoyed, which was all about kind of making the fluff work for you, and you can actually learn the fluff, which is really nice, because in the end, if the fluff changes your property rental or your property valuation by 10, 20, whatever it is, %, then it's worth knowing. Now, it might be the different color of cushions, it might be painting your wall a different color, but if that's all you need to do to increase your property valuation, not your rebuild value, but your property valuation, then I think it's well worth doing. Of course, I know absolutely nothing about it. My room and my house is constantly criticized by members on this webinar, but I look forward to learning with the rest of you as well. So thank you so much, everyone, for coming along tonight. Richard, Kev, it's been fantastic. Laura, I think you did very well. And we'll see you all next month. See you soon.
Thanks, everyone.
Lovely. Thanks, everyone.
Bye.